If you are not using a HSA, then chances are you are paying more in taxes than you should be, and you are missing out on one of the easiest wealth building strategies that's out there. Most people think that an HSA is just a personal savings account, but actually it's a great tax strategy that you can use to grow tax-free and help with some of your medical costs. So this year you can contribute tax-free, had to grow tax-free, and withdraw from it tax-free. And even if you don't use it all, you can save it for future use. So that's what I'm going to talk about in this video, how you can use an HSA to lower your taxes and build long-term wealth. My name is Keisha Rondeno. I am a real estate and business CPA and tax strategist. My goal is to educate you on business and tax strategies so you can save on taxes, keep more of the money you make, and build wealth in your business and your investments. So if this is something that you're interested in, make sure that you like this video and you are following. So let's get into all things HSA. So a HSA is a health savings account, very similar to a personal savings account that you can use on qualified medical expenses. But when you contribute to an HSA, the benefit is threefold. 1, you contribute to it tax-free. 2, it grows tax-free. And 3, you withdraw from it tax-free. This means that you're going to save on taxes now as well as in the future. And the best part about all of this is that this is an account that belongs to you. It doesn't belong to your employer. It doesn't belong to an insurance company. You control it. It belongs 100% to you. So when you contribute to an HSA, there are some contribution limits that you need to be aware of. So if you're contributing on behalf of yourself, a single person, then you can contribute up to $4,300 this year. And if you are contributing on behalf of your entire family, you can contribute up to $8,550. If you are aged 55 or older, then the IRS allows you to do something that's called catch-up contributions, which means that you can contribute an additional $1,000 per year to your HSA. Again, this is all pre-tax money, so it lowers your taxable income and what you will be paying on taxes. So the question is, who qualifies to contribute to an HSA? So in order to qualify to contribute to an HSA, you have to have what's called a high deductible healthcare plan. And in order for your plan to be considered high deductible, if you are paying on behalf of yourself, a single person, then your deductible must not be less than $1,650. If you are contributing on behalf of your entire family, then your deductible must not be less than $3,300. You also can't have any other health insurance. Now, you can have things such as a vision plan, a dental plan, short-term disability or long-term care plan. All of that is okay. It just can't be another medical health care plan. You cannot be enrolled in Medicare, and you also cannot be a dependent of anyone else. So if someone else can claim you as a dependent on their tax return, then you do not qualify for contributing to an HSA. Now, once you contribute to an HSA, there are so many medical expenses that you can use it for. So it can be used for hospital stays, for doctor visits, if you have any prescriptions, if you have any dental surgeries, or you have to get teeth cleanings, you need to buy more eyeglasses, you may have eye exam, physical therapy, lab work, surgery or outpatient procedures, and even emergency care. If you need to go to the emergency room, you can use the funds in your HSA for those medical expenses. Now, the one major exclusion that you cannot use HSA funds for is your healthcare premiums. Healthcare premiums are the one thing that you cannot utilize that's not considered to be a qualified medical expense. Now, when you utilize when you're paying funds from your HSA, you can pay using a check, your debit card, a credit card. All of that is fine. But what you do want to do is keep receipts so you can keep track of what you're spending and what you're spending it on, because you may have to verify those expenses that you are claiming as qualified medical expenses. So as you are contributing to your HSA, one of the best things about it is that this is considered to be an above the line deduction. And so you don't have to itemize deductions in order to utilize it. So this is great for business owners because it can be used to offset some of their business income as an expense. And if there is a particular year that you do not use all of the funds that you may have contributed to it, that's absolutely fine because it is going to roll over and continue to grow. If you have contributed to your HSA and you don't use all the expenses that are in there, it's completely fine because it is going to continue to grow tax-free. So really, it's a great long-term investment tool. And some HSA providers even allow you to utilize the funds in your HSA to invest in other plans, such as mutual funds, ETFs, and other assets. So it can be used very similar to a retirement account. So I usually advise clients every year to max out their HSA. And the reason why is because you don't have to use the funds right away. It's a tax deduction that you're going to get in the current year, and you'll have this growing tax-free pool of money that you can use on any future medical expenses, qualified expenses that is, including those that you may have in retirement. So I always advise clients to max out their HSA every year because if you don't use it, it's absolutely okay because it gives you a current tax deduction. You have this growing pool of money that you can use for future medical expenses, and you can use it at any point in time, even when you get into retirement age. And we all know as we get older, that's really when our health starts to change. I mean, as we get older, we tend to spend more money on health and medical. And so once you turn 65, there are additional benefits that you have once you have invested in that HSA. So you can still use all your HSA funds for qualified medical expenses, but you can also use them for expenses that are not considered to be qualified medical expenses. And when you do, you're not penalized on it. It is just considered to be ordinary tax that you are going to be taxed on if you use it for any expenses that are not considered to be a qualified medical expense. So once you get into retirement age, having an HSA is very similar to having an IRA. But it still gives you those tax-free withdrawals and helps you pay for those healthcare costs that you may have. And when you contribute to an HSA, then you have to report this information to the IRS. And the way that you do report it to the IRS is on a form 8889. That is where you report what your contributions are as well as what your withdrawals are. And if you have not contributed to your HSA by December the 31st of that year, you have until April the 15th of the following year in order to make that contribution. So for example, we're in year 2025. So if you do not contribute to your HSA by December the 31st of 2025, you have until April the 15th of 2026 in order to contribute to your HSA. Now, as you are making these contributions, it is super important to know that there are limits and you cannot exceed those limits. If you happen to make a contribution and you exceed the limits, then you're not going to get a deduction for it, and you may be penalized for those amounts that you've contributed in excess of what the limit was. So if you want to invest in an HSA and you don't have the funding readily available to you, the IRS allows you to do a one-time distribution where you roll over funds from your IRA into your HSA. And now it's important to remember that this is a one-time type of rollover that they allow you to do. So every year you can withdraw from your IRA in order to contribute to the HSA. This is a tool that the IRS allows you to in order to start the funding for the HSA. And this is what's called a qualified HSA funding distribution. It's specifically where you withdraw from the IRA in order to fund the HSA. So that's a really good strategy because that allows you to fund your HSA without affecting any of your current cash flows. So there you have it. If you are looking to lower your taxes, save for future medical costs, and build some tax-free wealth, then a HSA is a perfect strategy that you should be utilizing, especially if you are a business owner with a high deductible healthcare plan. So I hope this video has been helpful for you. Make sure that you like this video and you subscribe to my channel so you can get more tax and business strategies to help you save on taxes and build wealth. If you have any questions about the HSA or want to see a video on something else, make sure you leave that in the comments below. And also check out the description box below to where you can get some additional resources that may help you save on taxes and grow your business and your investments. I look forward to seeing you in the next video. Bye.